Lard Friese joins us now, the CEO of Aegon. Lard, thank you so much for joining us. Just reading through your statement, and I can see some of the commentary suggests it has been quite a challenging time with the geopolitics. Just walk us through what those developments meant for your company.
Well, good morning, Karen, and thank you very much for having, and Jeff, and thank you very much for having me again. Yes, of course, the first quarter has been a very volatile economic backdrop and geopolitical backdrop, given the devastating events happening in the Ukraine, and the impact, obviously, that we see of inflation on capital markets and a lot of volatility that we see in the equity markets. But in spite of all that, we're posting today a very solid set of results, which is basically a proof testament to all the hard work that we've done over the last 2 years to improve the risk profile of Aegon. And today, a solid set of results, profits dynamics up, growth dynamics still in good place, and a rock-solid balance sheet and solid solvency positions.
Can I just pick up on one of the comments too in the statement about a non-economic loss on interest rate hedges? We know it's been a fascinating environment with rates going up fairly rapidly and taking a lot of investors by surprise. Just walk us through some of those hedges and now how you're positioning around a high rate environment.
Yes, we have a lot of hedges and derivatives in place to ensure that we protect our solvency position. And while they come with some accounting noise, which you're seeing coming through in the fair value items today, they are there to protect the solvency ratios of the company. And look at them this quarter. They're rock solid. And when it comes to, let's say, the hedges that we have in place for the variable annuity book in the U.S., those hedges have demonstrated to be very effective, with a hedge effectiveness of 97% this quarter.
Lard, can I ask you about inflation and interest rates? It's both critical factors for the insurance segment here. How under attack is margin at the moment, and are you reluctant to write some new business because it's just not profitable enough?
Yeah, thank you, Jeff. Inflation is well, very visible, of course, everywhere in the world. And we manage inflation risk very actively as a company. So in October last year, we put inflation hedges in place of the largest balance sheet that is potentially affected for that in the Netherlands. So we were in time to do that well. Secondly, we manage inflation in the U.S. by adjusting products and by, of course, continuing to be forward-leaning when it comes to expense reduction plans, because inflation obviously will have a headwind for our expense reduction objectives that we have. But our plans have received renewed focus. Our progress in expense reduction is good, so we are still confident that we are able to attain our objective of 400 million expense reduction by the end of next year. Now, when it comes to interest rates, so to the extent that inflation is followed by interest rates movements upwards, interest rates up are good for our industry and are good for Aegon in the medium and longer term. Don't forget, we are a very large institutional investor, which has to reinvest a lot of its business and its premiums every year. And if you can do that against higher rates, that is obviously positive for us. Secondly, higher rates also mean that embedded options and guarantees in our products are weighing less heavily on the balance sheet. So that's another positive element of it. And thirdly, higher interest rates make, in general, life insurance and the kind of annuity products that we sell and that we offer to our clients more attractive for our clients. So in that sense, rates up are good for the industry, for the life insurance industry, and are good for Aegon.
Not great, though, for portfolios stuffed full of sovereign paper that's sitting at the wrong interest rate. And the trouble is, with the way the industry has been forced to price to market over recent years, it's meant that a lot of businesses have had to take on board that paper at those rates to match liabilities. Lard, I mean, in terms of the impact on existing portfolios, how concerned or otherwise should anybody be?
Well, again, I'm not concerned with our existing portfolios when it comes to interest rates up. Interest rates up are good for us. And we have scenarios that we continuously maintain to ensure that we very actively manage our balance sheet and our very large investment portfolio in connection with our liabilities to ensure that at all times and in all scenarios, the client's money is safe with us. And we've demonstrated that in the long period of low interest rates, and now interest rates are going up. We are going to benefit from that over time.
Lard, I was just looking at the item around growth markets, Spain, Portugal, China and Brazil, where we're not seeing much growth at this point. Do we need to rename this segment? How are you approaching it?
If I look at the growth markets, Brazil, China, Spain and Portugal, we're actually seeing buoyant growth in Portugal and Spain and also in Brazil. But we're not seeing that in China as a result of a development in China, a regulatory development in China that has lowered the demand for critical illness products, which are basically the product lines that we offer there to our clients. So this is a market-wide phenomenon that we believe is temporary, and we're going to, continue to expand the product range and address this to ensure that also in China we can benefit from the growth of China in general and from the massive size and the opportunities that market has to offer.
Briefly, Lard, can I just ask you about COVID? What are you seeing in the US business?
Well, we see, we see in COVID that, of course, in the Western world, in Europe and also in the United States, we're seeing COVID mortality, let's say, waning. And that is, of course, very good, first of all, and most importantly for everybody, because we all would like to get out of this pandemic. So we're seeing that also in the numbers and the development of the numbers. This quarter, we still saw COVID mortality coming through because COVID infections were very much there in the first couple of months, but we're now seeing the infections tapering off, and we can only hope that maintains to be the case, and to the extent that the pandemic moves into a more endemic state and we see less infections and less mortality, that is only good for our financial progress.
Yeah, well, we seem to be heading in the right direction, so fingers crossed for that. Lard, it's been a pleasure catching up with you. Lard Friese, the CEO of Aegon.